The AI memory gold rush, why Micron and SanDisk are surging, and where the risk lies. Traders now appear to be crowding into the riskiest, highest beta corner of the AI trade, commodity memory stocks. After months of enthusiasm around GPUs and AI platforms, attention has rotated aggressively toward memory suppliers, where price action has become increasingly parabolic. Micron Technology and flash memory specialist SanDisk are both up more than 40% in just the past month, a move that reflects not only improving fundamentals, but also a surge in speculative momentum. The near term justification is straightforward. Memory prices are rising sharply, inventories remain lean, and manufacturers have shown notable restraint when it comes to expanding production or ramping capital expenditures. After the brutal downturn of the last memory cycle, discipline has become the buzzword, and investors are rewarding it. With supply constrained and demand accelerating, earnings leverage is enormous, and memory stocks historically respond quickly when pricing turns. Yet history also offers a clear warning. Commodity semiconductor cycles almost always end the same way, with overcapacity. When pricing power returns, producers inevitably invest too much too fast, eventually overwhelming demand. This pattern has repeated for decades across DRAM, NAND, and other commoditized chip categories. The current cycle may be delayed or elongated, but the underlying incentives haven't changed. That risk is amplified by the nature of memory itself. Unlike NVIDIA's proprietary AI accelerators, where software ecosystems, switching costs, and architectural advantages create defensible moats, memory chips are largely interchangeable. Performance differences exist at the margins, but customers ultimately buy based on price, availability, and qualification. This makes the sector far more vulnerable to technological substitution and geopolitical disruption. Over the medium term, there's a real possibility that Chinese memory manufacturers, supported by state investment and strategic urgency, expand aggressively into DRAM and NAND, putting downward pressure on pricing and margins. That threat may not materialize this year or even next, but it looms over the space. Complicating matters further is the growing competition for manufacturing capacity inside existing fabs. High bandwidth memory, HBM, the crown jewel of AI infrastructure, now directly competes for factory space with DDR5, the latest generation of standard DRAM. DDR5 is a critical component in AI data centers, but it is also used in premium consumer devices. NVIDIA has leaned into low power DDR5 variants to reduce server energy consumption, a strategic move that improves efficiency but ties AI demand more closely to smartphones, laptops, and PCs. As a result, demand for data center memory is no longer insulated. It is increasingly competing head to head with consumer electronics for the same wafers and production lines. NAND flash adds another layer of strain. Used for high speed storage and increasingly embedded directly into AI servers, NAND is facing its own supply crunch. NVIDIA intensified this pressure at CES in Las Vegas when it revealed plans to add more NAND to server configurations to eliminate a key data bottleneck. While strategically sensible, the decision tightens an already constrained market and reinforces the idea that AI systems are pulling in every type of memory simultaneously. Despite these risks, this cycle is meaningfully different from past memory booms in two crucial ways. First, demand is no longer primarily driven by consumer products, which rise and fall with economic cycles. Instead, it's being powered by a massive multi year build out of AI data centers, a secular investment wave tied to cloud infrastructure, sovereign AI initiatives, and enterprise adoption. That distinction matters enormously for duration and visibility. Micron's revenue mix illustrates the shift clearly. In fiscal 2023, just 12% of its sales were tied to AI data center spending. In the most recent quarter, that figure jumped to 39%, and it is widely expected to keep climbing in the near term. This transition fundamentally changes how the company is valued and why investors are willing to tolerate higher volatility. The AI market itself is now concentrated around three categories of high end memory, all of which are in short supply. At the top sits HBM, the fastest, most complex, and most profitable form of memory. Before the AI boom, HBM was a niche product, used sparingly due to its cost. But as AI workloads exposed severe data bottlenecks, HBM became essential. In just a few years, it's grown from a rounding error into a material revenue driver. And as long as AI infrastructure spending continues, its expansion is likely to remain rapid. This is the most critical and underappreciated dynamic in the entire memory story. Producing 1 gigabyte of HBM displaces roughly 3 gigabytes of conventional memory capacity. In other words, the very growth that is boosting margins and revenues today is simultaneously tightening supply across the rest of the memory ecosystem. That displacement effect worsens shortages in DDR5 and NAND, reinforcing pricing power in the near term, but also increasing the temptation for the industry to overbuild in response. In short, the current rally in memory stocks reflects real structural change, not just speculation. But it also carries the familiar fingerprints of a commodity upcycle accelerating faster than fundamentals alone would justify. The opportunity is real, the momentum is powerful, but so are the risks once supply inevitably catches up.